Michael Burry is one of today's most well-known investors, but he wasn't always an investor. He began his studies to become a medical doctor, but he did so while trading his own funds in the markets that people pushed him to create a hedge fund, and the rest, as they say, is history. For decades, he has outperformed every major index as well as nearly every other prominent investor, including the infamous Cathie Wood. In the end, he correctly forecast the dot-com bust and gained millions as a result. He repeated the same thing 8 years later during the housing market boom and is now worth hundreds of millions of dollars. Then he became famous for the decade-long period during which his hedge fund was open to investors. It returned almost 500%, whilst the S&P 500 yielded only 3% to investors. It's no wonder, therefore, that many people, including myself, turn to him for direction as we navigate current market conditions, especially considering how volatile they are right now. Michael Burry has discovered a new rallying cause, a new event to tell everyone about and profit from, and it is, of course, the market meltdown we are presently experiencing. People love to make fun of Michael Burry, saying that he predicted 20 of the past 3 crashes and a slew of other amusing phrases. But 6 months after the latest top in the S&P 500 and the Nasdaq, no one is ridiculing him anymore. Everyone is instantly interested in what he has to say, and everyone is listening to every word. Once again, he correctly anticipated and benefited from a major market meltdown, but we're just 6 months into this one, which, according to popular belief, isn't a long period at all. So, luckily, we have his Twitter account to look at in order to attempt to address that issue, so today we'll take a quick look at what Michael Burry has been saying. Why is he concerned about the economy and what it may entail for the markets? This all starts with the tweet in front of you in which Michael Burry talks inflation, namely the concept that it was ephemeral, transitory, no peak, no to the moon. If you mean a chilly, gloomy place, the CPI news this morning was so bad that it transformed the bond market's perception of the Fed's direction and caused the weakest sector to break into bond lingo. MBS was sold with no bids and no bidders. Now, what he's referring to here is actually fairly easy. Earlier this month, we received data from the United States indicating that inflation has not peaked and is continuing to accelerate, which is bad news for pretty much everyone in the economy and markets because it means that the Fed's actions thus far have not been sufficient to tame inflation and that they need to go stronger now. Burry specifically mentions that fixed income assets and bonds are suffering as a result of this news. He actually admits that the bond market is dysfunctional, which is understandable. He claims that when you look at bond rates on that day, they really erupted, moving more than 30 or 40 basis points in just 8 hours. That level of volatility is nothing to be alarmed about, and it is indicative of a nervous market system that has no idea how to price. Now, Burry takes aim at the notions that inflation was always transitory or that we've reached the top of inflation, implying that they were both delusory. The fact is that, in recent months, no one has dared to mention the words inflation is transitory, since it's become a surefire way to completely invalidate your position and show everyone in the world that you don't know what you're talking about. The actual issue is that most investors, as well as the Federal Reserve, have been privately hoping that their transitory thesis was correct all along. Investors continued to pour money into overpriced tech stocks in the expectation that inflation was really ephemeral and would subside on its own. Unfortunately, the most recent CPI data that we received was the straw that broke the camel's back. Inflation is not transitory. It never was, and the only way to reduce it to reasonable levels is for the Fed to collapse the economy and market. Following that, we hear Michael Burry discuss the economy, which the Fed is going to wreck. Personal savings in the United States decreased to 2013 levels, and the savings rate fell to 2008 levels, while revolving credit card debt climbed at a record-breaking rate, returning to the pre-coverage peak. Burry showed us some graphs. Savings levels have fallen to decade-long lows, according to some data, at a time when the economy is still in upheaval, which means that when individuals lose their jobs, they will have less money to fall back on than usual. Finally, he observes that credit card debt is increasing at historic, all-time highs, indicating that the economy is considerably worse than most people believe. You feel that the basic reality is that consumers are in a pretty bad situation. They don't have much money in their bank accounts, and it doesn't grow much, month after month. Debt, on the other hand, is ballooning at an alarming rate. This is essentially a formula for a recession because there is no other option. Consumers no longer have money to spend, and this is just going to become worse. In short, Burry is suggesting that the stock path isn't finished since earnings haven't even begun to reflect the weak environment in which they're functioning, as it becomes increasingly difficult for a corporation to benefit from a struggling consumer. Next, Michael discusses how this will not be a quick process and will have to be traced out. It's easy to forget these days, but quantitative easing began after the Great Recession in 2008, not after the 2020 hidden pandemic. So much emphasis has been placed on the last 2 years because there has been an acceleration, but it has truly been a bull run powered by this massive liquidity and government money. Printing has been around for more than a decade, not just 2. In our opinion, equity prices will likely recover to 2010 levels, rather than the pre-covered 2021s when the economy became saturated with so much excess money. The crash here will most likely take a long time to accomplish this as well, and this is always the case. You most likely have an incorrect understanding of how bubbles function. The term bubble conjures up images of an asset class expanding and expanding until it can no longer take it any longer and explodes and collapses in a matter of days. The difficulty is that this never truly occurs. The dot-com bubble took around 3 years to deflate, despite the fact that no one in the world will tell you it wasn't a bubble. The 2006 housing market bubble took around 2 years to dissipate as well. We're only 6 months into this bear market, and it's not going away anytime soon. Following that, Burry emphasizes how tough it is to get things right, especially given the current market conditions. It's difficult to get just one thing perfect. The 1999 tech boom, the 2001 stock market rebound, and the 2005 housing bubble. The plain reality is that predicting the future is extremely difficult, and even Michael Burry isn't sure. What comes next is a conventional recession of a couple of years of slow growth and low asset values, followed by another boom cycle on the horizon. Is there going to be a stagflationary recession in which inflation remains extraordinarily high, limiting the government's ability to stimulate growth? The basic reality is that Burry doesn't know here, neither do I, nor does any other investor, but the statistics show that it won't be good. Finally, Burry had something more to say. It's like seeing a plane crash, as I said in 2008. It stings, it's not enjoyable, and I'm not smiling. The basic reality is that Burry received a lot of criticism after 2008. His own investors attempted to revolt against him and dump his short bets in the run-up to the real financial crash. He made them millions of dollars, some of them hundreds of millions of dollars, and they still came out of it hating him. However, the plain reality is that he did warn people about it. They just decided to disregard him. And even now, he is letting everyone know his thesis, thoughts, and characteristics, so no one should be able to complain that he isn't warning them this time. The basic reality is that people anticipate a day of falls in which 90% of all asset classes in the globe will crash overnight before markets begin to climb again. They demand a particular minute, hour, and day for this trigger, and if you provide anything less exact, they'll argue that you were incorrect anyhow. These individuals argue that certain predictions for these catastrophes were made too soon. Some make really bizarre assertions about what individuals are stating, alleging that they've been calling for a different crash every week for a whole year when, in reality, Burry's been asking for one main crash for approximately 18 months. People who previously ignored Michael Burry are the same people whose portfolios are suffering now. The thing is that you only need to be able to return at a lower cost average than when you went, which Michael Burry is plainly capable of. If you like this video, please like, comment, and subscribe to help the YouTube algorithm. I'll see you in the next video.